Bill Hayes, Kenilworth Asset Management, and here we're going to talk about today is about income, and we're going to call this Getting Income Part 2. And what we're going to talk about using today is an equity idea known as Master Limited Partnerships, or MLPs. MLPs are a creation that started about 20 years ago, and what it was is they were designed to help the oil and gas industry go to the market and raise money. What an MLP does is it allows a company like a gas exploration or a pipeline company to get money into the marketplace using the stock. Now, this equity is very specific in respect that how it's treated as the income is treated. The income is not treated as normal income that you would normally think about dividend paying stocks. The income is actually treated as return of capital. So what that means is that this is actually a tax-deferred income vehicle. So let me give you an example on how it works. If I own a stock, let's say the company trades at $25 a share, and it pays a $2 dividend. I hold it for a year. Well, over that year's time frame, I'm getting $2 given to me in this dividend. When it comes time to report this dividend on my tax statements, I'm actually not reporting it as a taxable event. I'm actually reporting this as just income that came to me, but it reduces the cost basis of my stock. So what that means is when I sell the stock, if I sell it a year out, what will happen is if I bought it at 25, I took $2 in, I now report the sale of that stock and my cost basis at 23. So my gain, it's actually treated as a capital gain, and that's why you want to make sure it's a long-term capital gain so you get the favorable treatment versus a short-term, which can be anywhere with 40% right now, so you don't want to do that. The beautiful part about these stocks is not just because of this tax-deferred income that you're getting, the other nice part about it is that these are also growth stocks. In the respect that as they make more money, they're mandated because these are special vehicles built to give cash flow to the oil and gas companies, but it also a way for us to get favorable tax treatments on the stocks. They have to pass through earnings to the dividend. So now what happens? This is where it gets to be fun. If they have a good year, and let's say the natural gas area is doing well and the oil and gas area is doing well, if they have a good year, well, what happens is now they start raising their dividend. They raise their dividend, more people start buying the stock. So now what do you have? You have a stock that's going up and you got dividends that are going up. And meanwhile, these dividends are all coming to you and it's all tax deferred until you sell the stock. So if you have a 7% yield on the stock, let's say, and the stock grows by, I don't know, 5%, you have a 12% rate of return on what's a rather comfortable stock with a good solid core business. So what we do is we use this as another way to get income. And it's not I'm advocating any of these companies. We're not advocating buying or selling. And for full disclosure, I own some. But names that we use are that we know are Kinder Morgan, KMP, Western Gas, which is WES, which is a spin-off of Anadarko, Enterprise, ETP, and Enbridge Partners, EEP. These are all good companies, good solid bases. Well, you do the research on yourself. One other caveat, the dividend, because it is treated as return of capital, does issue you a K1. So you have to talk to your accountant about that. There is discussion whether you want to use these in an IRA because of the tax treatment of the dividend, but that's something you'd want to talk to your accountant about. But for more information on strategies like this and others, feel free to give me a call, Bill Hayes, at Kenilworth Asset Management. Number is 847-920-0400. Thanks, and have a great day.